Warren Buffett, also known as the Oracle of Omaha, is one of the most successful investors of all time. Over the years, he has shared his investment philosophy and strategies with the world. Here are 50 of Warren Buffett's most important investment tips from age 50 to 2020. One. Buy stocks of good companies that have been beaten down by temporary setbacks. 2. Invest in companies with a durable competitive advantage or economic moat. 3. Invest in businesses you understand and can explain in simple terms. 4. Look for stocks that are undervalued relative to their intrinsic value. 5. Be patient and focus on the long-term potential of your investments. 6. Don't get distracted by short-term market fluctuations or noise. 7. Invest in companies with ethical and trustworthy management teams. 8. Avoid companies with high levels of debt or that are overly complex. 9. Focus on businesses with strong cash flows and solid balance sheets. 10. Always have a margin of safety in your investments to protect against downside risks. 11. Invest in companies that can reinvest their earnings to generate growth. 12. Look for companies with high returns on equity or invested capital. 13. Invest in companies that generate consistent and predictable earnings. 14. Avoid trying to time the market or make quick profits. 15. Buy shares of companies you would be happy to own even if the stock market was closed for the next 10 years. 16. Be willing to hold onto investments for the long term, even if they may be out of favor in the short term. 17. Avoid over-diversifying your portfolio to the point where you can no longer keep track of your investments. 18. Focus on businesses that have the potential to grow and compound their earnings over time. 19. Invest in companies with a solid and sustainable competitive advantage. 20. Look for businesses with high barriers to entry or that operate in niche markets. 21. Don't be afraid to invest in businesses that are out of favor with the market or Wall Street. 22. Invest in companies that are managed by people with a long-term vision for their business. 23. Avoid investing in companies that have a lot of short-term debt or liabilities. 24. Don't be swayed by the opinions of others or the news media when making investment decisions. 25. Invest in companies that are able to generate strong cash flows even in tough economic times. 26. Look for companies that are able to generate a high return on invested capital or assets. 27. Invest in businesses that have a track record of paying and growing their dividends. 28. Avoid investing in companies with a lot of stock-based compensation or options. 29. Focus on companies with a strong brand or reputation in their industry. 30. Look for companies with a history of smart capital allocation and avoiding expensive acquisitions. 31. Invest in businesses that have the potential to benefit from long-term trends or demographic changes. 32. Avoid investing in businesses with a lot of goodwill on their balance sheet. 33. Invest in companies that are able to generate consistent and sustainable earnings growth. 34. Focus on companies that are able to generate high returns on capital employed. 35. Look for businesses that are able to generate a lot of cash flow from their operations. 36. Avoid investing in companies that rely heavily on debt to finance their operations. 37. Invest in businesses that are able to generate high levels of free cash flow. 38. Look for companies with a history of strong shareholder returns and a track record of returning capital to shareholders. 39. Avoid investing in companies with a lot of intangible assets or goodwill on their balance sheet. 40. Invest in companies that are able to grow their earnings through organic means rather than acquisitions. 41. Focus on businesses that are able to generate strong earnings growth with minimal capital expenditures.